Greetings, listeners of Stock Explorers, and welcome to this deep dive.
Great to be here.
Today, we're taking a really close look at Supermicrocomputer. You probably know them as SMCI.
Right, a company that's really become central to this whole AI conversation.
Exactly. And our goal today is to sort of unpack their business, look at the key points, especially for potential investors. We want to make it accessible.
And we're starting with some big news, right? The DataVolt partnership.
That's the plan. But first, just setting the stage, SMCI, they're positioning themselves as a key player in the AI revolution.
Absolutely. They talk a lot about their total IT solution approach.
And the building block solutions.
Yeah, that's core to how they build things, offering customization. And don't forget their leadership in direct liquid cooling, DLC. That's becoming huge.
Right. And it's important to note up front, isn't it, that AI is now the lion's share of their business, like 70%.
Around that, yeah. 70% of revenue tied to AI sales. So definitely an AI story.
Okay, let's jump into that headline then. The DataVolt agreement. $20 billion.
Right.
It's massive.
It really is an eye-watering number.
So who exactly is DataVolt, and what's the structure of this deal?
Okay, so DataVolt is a Saudi Arabian company. Their focus is building these huge hyperscale data centers.
For AI specifically.
Primarily, yes. This deal runs for 10 years, 2023 to 2033. SMCI is supplying the GPU platforms, the dense ones, and the full rack systems.
And the deployments are where? Just Saudi Arabia.
Both Saudi Arabia and the U.S., actually. And get this, $12 billion of that $20 billion is expected just by 2026.
$12 billion in the next, 2 years or so? That's incredibly fast.
It is. It's a really ambitious timeline.
Right. It feels like there's more going on here than just a standard supplier agreement. Strategic alignments, maybe?
Oh, definitely. You can see how it fits bigger pictures. It aligns with the U.S. push for, more domestic tech manufacturing.
And Saudi Arabia's goals.
Exactly. Their Vision 2030 trying to become a global tech hub. A critical piece is that the deal guarantees a U.S.-made supply chain for the GPU systems.
Ah, okay. So youth manufacturing gets a boost. DataVolt gets reliable, high-performance gear.
Powered by renewable energy. That's part of their plan, too. Sustainable data centers.
That long time frame, out to 2033, that must give SMCI some much-needed stability, wouldn't you say, compared to their past ups and downs?
That's a really key potential benefit, yeah. Unprecedented long-term revenue visibility could smooth out those quarterly fluctuations we've sometimes seen.
But a deal this big, this fast, there's got to be risks, right? Execution risks.
Huge execution risks, absolutely. It's ambitious. And remember, they just missed their Q3 FY25 revenue forecast.
Right, and lowered guidance.
Exactly. They cited things like delayed AI adoption timelines, economic uncertainty. It's a reminder that even with a giant deal like this, things can get complicated. Deployment at this scale isn't easy.
And it's not just about hitting the revenue targets. What about the profitability? These advanced systems, liquid cooling. That sounds extensive.
That's the other side of the coin, isn't it? The specifics here, costly liquid cooling, custom engineering, could definitely squeeze their gross margins.
We already saw margins dip in Q3, didn't we?
It did. So the big question for investors is, can they manufacture and deploy these complex liquid-cooled systems efficiently enough to make this deal truly profitable, not just big on the top line?
Okay, so the DataVolt deal is huge, but is it a one-off? Or are they looking at similar partnerships elsewhere, maybe UAE, Qatar? The whole region seems hungry for AI infrastructure.
There's definitely chatter about that. Analysts asking, the company hinting at regional interest. The UAE and Qatar certainly have AI ambitions.
And U.S. tech firms are keen on the Middle East generally.
Right, so the conditions seem ripe. But nothing concrete announced for SMCI specifically in the UAE or Qatar yet beyond, general discussions. DataVolt is the big confirmed one for now.
It's interesting how politics seems woven into these deals. The timing of the DataVolt announcement, coinciding with that U.S. presidential visit.
Yeah, that wasn't likely a coincidence. It highlights the geopolitical angle. These massive tech infrastructure projects often have that dimension. Future deals in the region, probably influenced by diplomacy, too.
Okay, let's zoom out again. AI is driving, 70% of their revenue? What are the growth projections looking like overall?
Analysts are generally pretty bullish. They're talking a CAGR, compound annual growth rate, of around 37% between fiscal 24 and 27.
37% CAGR.
Yeah.
And for this year, FY25.
The forecast range is between 74% and 101% growth for FY25. And looking out to FY26, targets are anywhere from $33.6 billion up to SMCI's own $40 billion goal.
Those are staggering numbers. What's fueling that? Is it just these mega deals?
The big deals help for sure, but it's also broader adoption by hyperscalers, the big cloud companies and large enterprises. Plus that demand for direct liquid cooling. Reports suggest it's going into like 30% of new data centers. And SMCI's speed getting systems out quickly with the latest GPUs, like NVIDIA's Blackwell, that first mover advantage is huge for them.
But being so dependent on AI, that feels risky too. You mentioned the Q3 miss was partly customers waiting for Blackwell.
Exactly. It's a double-edged sword. Being an AI pure play is attractive in a hot market, but it makes you vulnerable.
Vulnerable to tech cycles.
Yeah. Rapid GPU changes, intense competition. If customers pause for the next big chip like they did for Blackwell, it hits SMCI hard. Harder than, say, a more diversified competitor. Inventory management of older tech is tricky too.
So given that competition, where does SMCI actually sit in terms of AI server market share?
Estimates for 2023 put them around 12%. Bank of America thinks that could grow maybe to somewhere between 10% and 17%.
And their strategy to grow that share?
It comes back to speed to market, customization with those building blocks, and this push towards being a total IT solution provider, hardware, software, storage, support, the whole package.
Partnerships must be key too, right? With NVIDIA, AMD?
Crucial. Those relationships are vital. And they need the manufacturing muscle to back it up.
Which explains the big expansion efforts. That new Silicon Valley campus growing in Asia.
Absolutely. They're aggressively adding capacity. The new Silicon Valley site is focused on racks, especially liquid-cooled ones. Expansions in Malaysia, Taiwan, too. It's all about being able to build more faster to grab that market share.
Okay, so speed, customization. What else really differentiates them from the big guys like Dell or HPE?
Well, besides speed and customization, it's that liquid cooling expertise DLC. And they even have DLC-2 now. That's becoming really important for these power-hungry AI chips.
And the green computing angle.
Yeah, energy efficiency is a big selling point. And that shift to total IT solutions is key. If they can bundle hardware with their own software, like Super Cloud Composer and services, it creates stickier customer relationships.
And potentially better margins down the line.
That's the hope, yeah. Moving up the value chain.
Who are their main customers then? Is it all hyperscalers?
They serve a pretty wide range. Enterprise data centers, cloud providers, obviously AI specialists, but also 5G telecom infrastructure, edge computing.
So not just the giants?
No, the cloud service providers, the CSPs, and big data center operators are major, for sure. But they're seeing good growth in the enterprise and channel segments too, and adoption seems to be broadening.
And the overall market forecasts for AI servers just keep going up, don't they?
It's pretty incredible. CAGR over 18% through 2032, maybe hitting $177 billion. Some forecasts are even higher.
Wow.
And that specialized market for DLC servers, that's expected to grow really fast too, which plays right into SMCI's strength.
Okay, let's talk financials again. They updated their guidance for FY25 recently. What are the numbers now?
Right. They adjusted it down slightly. Full year FY25 revenue is now guided to $21.8 billion to $22.6 billion.
And for the current quarter, Q4?
Q4 projection is between $5.6 billion and $6.4 billion in net sales.
What are the assumptions behind that? Are they basically counting on catching up from the Q3 delays?
Pretty much. They're assuming those delayed sales come through as customers finally get the new platforms, especially Blackwell, and that the ramp-up of these new platforms goes smoothly.
While keeping an eye on the economy and tariffs.
Exactly. Those are still lingering uncertainties, they mention.
So the total addressable market, the TAM, is huge and growing, driven by AI and cooling needs.
Massive TAM. And SMCI's strategy, becoming that total IT solution provider, is really about grabbing a bigger piece of the whole AI deployment pie, not just the server hardware slice.
It really puts their market cap into perspective, doesn't it? When you have a single deal like DataVolt worth potentially $20 billion, almost matching their market cap at times.
It really does. Their market cap has been, well, volatile, around $19 billion to maybe $26.5 billion recently, I think. But yeah, that DataVolt deal alone shows the potential scale and the risk. Their future value is heavily tied to executing these huge projects successfully.
And execution relies heavily on that global manufacturing expansion we talked about.
Yeah.
Silicon Valley, Malaysia, Taiwan, Europe.
It's fundamental. Building resilience, avoiding over-reliance on one region, managing tariffs, and crucially, shortening that time to market and time to deployment. That's the goal. Faster delivery wins deals in this market.
Okay, we need to dig into those Q3 results a bit more. The miss on revenue and earnings. What were the key takeaways for investors there?
Well, the headline was the miss. $4.6 billion in sales, below forecast. Both GAAP and non-GAAP earnings per share also came in lower than expected.
And the reasons?
Officially. Customers delaying orders waiting for Blackwell GPUs from NVIDIA. And a one-time inventory write-down for older GPU tech. It just highlights how tied their performance is to NVIDIA's product cycles right now.
And thinking about risk, we have to mention the past governance concerns. The accounting issues, the auditor resigning. Where do things stand now? Is that shadow still hanging over them?
It's a fair question. Those were serious issues back then, Ernst & Young resigning. But look, they've addressed them formally. They're current with SEC filings now, back in compliance with NASDAQ.
And there was an internal investigation.
Yes, an independent special committee reviewed everything and found no evidence of fraud or misconduct by management or the board. That's the official finding.
But
they did disclose material weaknesses in internal controls in their last annual report, the 10-K. So while the past issues are formally resolved, that disclosure, plus the history, might still make some investors cautious. It's part of the risk profile you have to consider.
Okay, so putting it all together, what's the snapshot of their current financial health? Debt, cash, margins.
Overall, it looks reasonably okay on the balance sheet. They have a decent amount of cash, roughly matching their total debt. They did that convertible note offering recently, raising $700 million, likely for growth in CapEx.
But the margins are the worry.
The gross margin dip in Q3 was notable, yeah. They listed a bunch of reasons. Competition, higher cost for liquid cooling, customer mix, inventory reserves, lower volume during the transition, some expedited costs.
So perfect storm kind of quarter for margins.
It seems like it. They have a long-term target for gross margins, but investors will definitely be watching that closely in the next few quarters.
And did they address those past analysts' concerns about accounting directly?
They've taken steps, yes. Got the filings up to date, hired a new auditor, added a board member with risk expertise searching for a CFO. So actions have been taken.
Any dividends or buybacks?
No current dividend. They've done buybacks in the past, but nothing active right now as far as recent filings show.
What about cash flow?
Q3 showed positive cash flow from operations and decent free cash flow, actually. Of course, like any global company, they face currency risks, and rapid growth always puts demands on working capital.
Managing that NVIDIA supply chain must be a constant juggling act. You hear stories about chips being rerouted.
It's absolutely critical. Getting enough of the latest NVIDIA GPUs and getting them on time is paramount. Being first to market helps them get priority access often.
And diversification helps too, bringing in AMD, Intel.
Yes, incorporating AMD CPUs and GPUs, Intel's Gaudi 3, looking at ARM. That's key for long-term supply chain health and reducing dependency. Plus, the global manufacturing footprint helps manage geopolitical risks and trade issues.
Let's circle back to management and governance. Despite the special committee finding no fraud, those past issues, the EY resignation, lawsuits, Hindenburg's report, must have shaken confidence. How are they rebuilding that?
It's an ongoing process. The committee's findings were important, getting filings current, the new auditor, the board addition. Those are concrete steps.
But rebuilding trust takes time.
Exactly. It requires sustained performance, transparency, consistently hitting targets, and adhering to high government standards. They seem focused on communicating their strategy clearly, highlighting growth drivers, being open about challenges on earnings calls, and engaging with analysts.
Still, there's ongoing litigation, right? Class action investigations.
Yes, those things often follow periods of volatility or past issues. It's something to be aware of.
And the high short interest in the stock, what's driving that, do you think?
It's probably a mix of things. Lingering governance concerns for some, the margin pressures we discussed, the fierce competition, maybe just skepticism about sustaining this incredible growth rate. Short sellers might also be betting on execution hiccups with big deals or supply chain issues.
So what metrics are management themselves really focused on? What are their KPIs?
You'd look at revenue growth, obviously, the AI contribution percentage, gross and operating margins, EPS, cash flow generation, time to market for new products, design wins, manufacturing capacity and utilization, and increasingly, the adoption rate for their liquid cooling tech.
Okay, let's talk competition again. We mentioned Dell, HPE, Gigabyte. How does SMCI really position itself against them?
Their pitch is agility, speed, and customization. They aim to be faster with new tech than the giants. Their building blocks allow tailoring that might be harder for vendors selling more standardized boxes. And they lean heavily on that liquid cooling edge and green computing focus. The total IT solution is also part of positioning, offering more than just hardware.
How do they handle the inevitable price wars in hardware?
by trying to add value elsewhere. The total solutions, the specialized tech like liquid cooling, emphasizing energy savings, operational efficiency from their new factories, and just being first with the fastest stuff often allows for better initial pricing.
What about emerging tech? Custom chips from the cloud giants, FPGAs. Does that threaten SMCI's model?
It's something to watch. Custom ASICs are definitely a trend. But SMCI's strategy of integrating the best available merchant silicon NVIDIA, AMD, Intel gives them flexibility. As long as there's a need for optimized systems built around someone's advanced chips, SMCI has a role. But yeah, more competition, including from new entrants, is a certainty.
And how do they maintain that near pure AI play perception as the market evolves?
By staying laser-focused, really. Always integrating the absolute latest AI accelerators, developing highly optimized systems for AI workloads, and targeting customers with the biggest AI compute needs. The challenge is staying ahead as everyone else adds more AI features to their standard servers.
So, wrapping up with market sentiment, it sounds quite divided. Some analysts bullish, others cautious.
Very much so. You've got firms like Raymond James saying outperform, pointing to AI leadership and DataVolt. Then others are more neutral or negative, worrying about margins, execution risk, competition, the macro environment, or that governance history.
And investor sentiment reflects that.
Seems like it. High trading volume. Sometimes the price gets pinned, suggesting strong opinions on both sides. You see a lot of enthusiasm, especially maybe from retail investors focused on the growth story, but also caution, perhaps more from institutions weighing the risks more heavily.
Looking out longer term, 5-10 years, what's the big vision? Where does SMCI want to be?
They want to be a dominant global player in total IT solutions across AI, cloud, storage, 5G, edge, basically critical tech infrastructure. The goal is massive scale, sustained growth, driven by innovation, global reach, and that green computing angle.
Expanding beyond hardware.
Definitely. More into software and services, broadening the AI portfolio beyond just GPUs, using DataVolt as a springboard for more big deals, especially in the Middle East and other high-growth regions.
Biggest challenges, opportunities.
Challenges. Managing competition, maintaining margins during rapid expansion, supply chain stability, flawless execution on huge projects. Opportunities. The sheer size and growth of the AI market, leveraging their speed and cooling tech, becoming that end-to-end solutions provider, and adapting to whatever comes next in AI hardware by being the best integrator.
Okay, so let's try and summarize the key takeaways for listeners thinking about SMCI. It's clearly a major force in the booming AI market, right? Huge growth potential, especially with deals like DataVolt.
Definitely. Strong position, big opportunities, technological strengths too, especially liquid cooling, speed, customization.
But, and it's a significant but, there are risks. Executing those massive deals is paramount. Margin pressure is real, competition is fierce. And that historical governance stuff, while addressed, might still linger for some.
Exactly. So if you're invested or considering it, you need to watch key milestones closely. How is the DataVolt project progressing? Are they hitting targets with new product launches like Blackwell adoption? Are margins stabilizing or improving? Is financial performance steady?
It really feels like a high-stakes balancing act between incredible growth potential and significant operational and financial risks.
That sums it up pretty well. High growth, high stakes.
A final thought maybe for listeners, how sustainable is this explosive growth in AI hardware long term? And can a company like Supermicro balance that breakneck innovation race with financial discipline? Something to ponder.
A very relevant question for the whole sector indeed.
All right, that's our deep dive on Supermicro Computer for today. Hope you found it useful. Please remember to subscribe, give us a like if you did, and hit that notification bell so you don't miss our next exploration.
Thanks for tuning in.